The election is nigh, and we will discuss a little bit of economic implications related to it, but we're really going to be focusing a little bit more on your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where I am open to your questions, and I take them live in this unscripted manner. I do want to touch on another economic theme that I've heard mentioned once or twice with respect to the election that I thought I could address. Again, just taking a look at the figures, at the data, and seeing whether or not we think that there are going to be some important implications for things like inflation, whether it's going to create big logistical problems and stuff like that. And what I'm talking about now is immigration, because there's obviously been a very distinct policy difference between former President Trump and current Vice President Kamala Harris and their policies on immigration, although she has emphasized that one of her first items that she would address is a bipartisan border bill. That compromise border bill, if the town hall with Anderson Cooper is an indication, one of the things that was included in that was a bit of money for the border wall, which when pressed on it, she responded that she was not opposed or afraid, actually, I think was the word she said, she's not afraid of smart ideas. So I guess she has changed her perspective on that. But actually, there's kind of a more important question economically. I realize that people can have differences of opinion about how much immigration the country should have. But there have been some statements made about the economic implications of immigration. And I wanted to address that. I think we have a video clip where that's indicative. This is, we've seen this kind of thing once or twice. There's obviously it's a much deeper repository of comments and more nuanced ones than these that have been made. But I think we can play that. So if we're able to, and by the way, we're only working with one producer today, so we're a little bit shorthanded. But hopefully we can pull this video up and see what a couple people had to say about immigration.
He's going to devastate our economy. Tourism, construction, agriculture. I mean, you're going to have vegetables rotting in the fields. You're going to have construction sites that will lie dormant or certainly will struggle to get workers to be able to help make sure that they can make progress. The tourism and restaurant industry in particular.
And we need immigrants in this country. Forget the fact that the farm that our vegetables would rot in the ground if they weren't being picked by many immigrants, many illegal immigrants.
Okay, so I'm not sure if you were able to hear that. I had previously watched it, and I was not actually catching that through my IFB, so I'm hoping that you guys were able to hear what was said. So what was being discussed, if you did not hear it, was that we rely considerably on immigrants for things like farm workers and picking crops. And, of course, we've gone through one sort of logistical nightmare during the pandemic. We've realized how that can create shortages. It can create severe inflation in some cases. And I think the suggestion by these two was that we could have both of those things, and we could actually just have crops rotting in the field. And I wanted to address that a little bit because that's not really consistent with reality. We do have some big problems on the immigration front in as much as it has to do with farm workers, but not so much on this. So the first thing I would say is that at least by the Border Patrol's own numbers, we're bringing in we're not bringing them in. They're coming in over the southern border about 2 million people a year during the current administration. In total, the United States has about 2.4 million temporary farm workers. And it is true that the bulk of those are immigrants. And a good percentage of them are undocumented immigrants. So the Department of Labor, if you don't know, actually conducts a survey. So they have a pretty good sense of what they're dealing with. Now, because you're having a survey where they're going and talking to these farm workers, it's possible that some of them are not telling the truth about their immigration status for fear that there might be some repercussions. It seems unlikely, though, given what some of the statistics are. I'm going to read some of those to you now. So, again, the USDA Census of Agriculture estimates that there's about 2.4 million farm workers on the nation's farms and ranches. Now, interestingly, we do have a guest farm worker visa program in the United States. It's the H-2A visa program, and there's actually no limit on the number of H-2As that can be granted. So, at least according to the Department of Labor's analysis, about 68% of the farm workers in the United States are foreign-born. The overwhelming majority of those come from Mexico. What is interesting, though, also, is that on a self-reported basis, 85% of those have been in the United States for 10 years or more. And I think it's 70% of them, I'm going to see if I have this, 70% have been in the country for 15 years or more. The H-2A visa program is pretty deeply flawed in my view. One of the reasons for this is that the approval process for the H-2A visas on average is between 60 and 75 days. And the average migrant farm worker is working within the United States for about 39 weeks per year, and not always at the same farm, because this is related to crops and seasons. So clearly we have a massive efficiency problem. But there is no reason why we would not be able to document more of the farm workers than we currently do. About half, self-reporting, about half of them are undocumented, meaning that they don't have either a green card, they are not naturalized citizens or here in some other way legally, or you have an H-2A. I also happen to think that we need to dramatically increase our H-1Bs for what it's worth. I think that one of the biggest challenges we have is that we have a lot of needs in the United States, and fulfilling those needs is a really complex process. We used to employ a number of people when I was in New York at Cantor Fitzgerald. We employed a number of people who were on H-1Bs. There's actually a law firm in New York called Fragaman that kind of focuses on this type of work, which is it was unnecessarily clunky, and that there are caps, by the way. So for specialized forms in professions and things like that, where there's specialized expertise, you have the H-1Bs, and there are limits to that. But I do want to point out that when you hear these kinds of claims about the potential of immigration policies impacting things like crops, they really are ignoring almost all of the data. They are ignoring the fact that we have a program to document temporary farm workers, and most of the farm workers have already been here for a decade plus anyway. 85% 10 years or more, 70% 15 years or more. And in any case, the total number of farm workers is nothing like the number of immigrants coming in. So, this sort of goes back to what we talked about on Monday when we were talking a little bit about home builders and whether or not they were net, immigrants are a net benefit to the number of homes and home prices. The answer, by my work at least, is they are not. That is not to say that I don't think we should increase the documentation. By the way, another just piece of evidence that we really can and should probably become a lot more efficient at this process, for this type of thing, is the fact that as it currently stands, the administration has a catch and release policy, which is that when there are obviously the gotaways, so what they estimate come over the southern border that they don't end up having contact with. But amongst the millions that they do have contact with, catch and release means that they do not have these people in custody for more than 72 hours. And it strikes me that if you have somebody in custody for 72 hours, you have time to try to find out who they are, find out why they're here, and possibly, not even waiting for a hearing on things like asylum or whatever else, but come up with a significantly expedited process for those who are here for economic reasons, such as coming up here to work as farm workers temporarily. So just an observation that the implications for crops, for produce prices, in California, obviously, the percentages are probably overwhelming that we are dealing mostly with immigrant farm workers here. 40% of the produce that is consumed in the United States is grown in the state's Central Valley. And obviously we would like to see some more efficiency there. But if people are panicking about inflation or logistical snafus that might be associated with even just reverting back to immigration policies that were in place 4, 5, 6 years ago or 10 years ago, pick the time horizon of your choosing, I think that concern is grossly overblown, and the potential costs of it are also grossly overestimated. Okay, so having gotten that out of the way, I figured we would move on to some questions, and I really appreciate it because a number of you had talked about some things, and I had mentioned on Monday that from my perspective, we still have a circumstance where things like gold and Bitcoin and so on, that those, real estate, that those trades largely remain intact. Steepener trades, so again, not crazy about long-dated treasuries. If a steepener trade, by the way, is a bet essentially that longer-dated interest rates are going to rise more and faster than short-dated rates would. So those things all remain intact. But one of the questions I got was about Newmont Mining. So I figured we could, and also about C-Web and K-Web. We're going to talk about that because actually I think there's a little bit of election stuff going in there as well. But, oh, and I just put that one in because I was talking about it. So first things first, why don't we just bring up Newmont Mining, if I can, if it'll go up on that. Maybe it won't. That's all right. I have other systems. We can use one of those. So let's just take a look at Newmont. So one of the things that you have probably heard before is that the miners are levered ways to play gold. And that actually, over the longer term, hadn't held up as being true. And to illustrate that, let me just quickly compare how something like Newmont did relative to GLD, which we'll use as an equity proxy. There was a period where the miners definitely were not delivering that kind of 2x return that some, that in the short term, I think that was kind of a number that was thrown out a lot of times. The idea being that they are levered to the price of gold because they sell gold, but provided that their operating and input costs don't go up at the same pace, that their margins should expand. So therefore, they would have essentially more leverage to the metal. For a lengthy period of time, that did not prove to be correct, as we can see here. So where you see that is on this bottom chart. And so, well, I'm going to just quickly flip this around. So I'm just going to show that here. So this is long Newmont, short gold. And you can see that between here, which is April of 2022, and the present day, that you've been far better off being long the metal than the miner. So I happen to believe, though, that could potentially turn around. And I think that's one of the things that creates a little bit of, well, I'm not going to call it a margin of safety so much, because the miners are still a relatively speculative place to play. And, so you're speculating on the price of gold in dollar terms. And, miners have not just the input costs in gold to concern themselves with. In many cases, they operate in geographic locales where they face material political risk. You could have countries decide that they're going to nationalize mines, or if you're operating in places like various places in Africa, or Indonesia, South America, these are areas where those are not risks you can completely ignore. Nevertheless, what we're looking at here is, I'm going to get rid of the price for a second. So I'm just going to have the trailing price to earnings and the forward price to earnings. And actually, why don't we just take a look at the forward price to earnings, because I think this is probably as good a way to look at this as any, over a 5-year period. And what you can see for Newmont is that it's right now definitely at the lower end of that range in terms of valuation. And this is, you can also see here on a price to sales basis. I'm only using price to sales because if you were wondering whether that's simply because margins had blown out on higher gold prices, for example, that was going to be the reason for this. So you are buying it at close to 5-year lows, I would guess, on a multiple basis, which is, obviously a better place to be. So I think, I do, if I like gold, then I have to like the miners, and I kind of have to like Newmont here, because relative to its own historical valuation, it's looking quite reasonable. And actually, there is one other thing we can take a look at, which is, because each one of these is going to be a little bit different, so it's probably worth taking a look at their geographic exposure just to get a sense of where it's coming from. I don't know how well you can see this. Let me see if I can blow this up a little bit. So what we're looking at here is, revenue sources by location. And so, in the case of Newmont, it's I guess, for the space, it's not terrible. So how might one go about doing this? And how far out might one do this? I guess a couple things to think about. We should probably take a look at the technicals. They just had their earnings, and the stock got hit. That's one of the reasons why it's trading at this cheap multiple now. So you have to look out until early next year, basically. From a technical standpoint, you can see that there are a handful of bullish signals, but by and large, it's negative. And that's part of what has created this opportunity. And you can see that it's fallen back here. I would guess that, probably the next potential stop where you could find some measure of support is going to be down and around the 200-day, or maybe even the 150, which we're probably bouncing on right about now. Let's take a look. It's got to be very close to that. Yeah. So if you can see this, I'm going to highlight that in there. So you can see we're really right on the 150. So kind of a critical level here. But the 200 is going to be down around 43. So, and these tend to have a higher implied volatility. So I think call spread risk reversals, potentially looking out to the next earnings or thereabouts, or at least into the new year. So the next earnings is going to be late February. That one might be a little bit tough, because that might mean that you would have to go out to March, if that's true. One of the things to remember about call spread risk reversals, the same thing is, first of all, you have a call spread. So you're just the vertical spread element of it alone. If you push those out too far, they're just not going to move that much, which is a little bit of a problem. So you might not be able to capture that next one. So the delta of that call spread element alone is not going to be that great. But let's go like this. We just go out to January and see what this looks like. So again, 200-day probably in and around the $43 level. So, you know, that's going to be the strike of the put there, or maybe a little bit lower, that you would be willing to sell. You know, where you might be willing to get put the stock, hoping that it finds some measure of support there. But we'll just go like this. Oh, I need to take this out in expiration January. Okay. So we can choose the 47.5 calls to get long, short the 52.5s maybe. And then we're looking at like the 42.5. So it's going to look a little bit something like that if you're going to use a call spread risk reversal. That would be one way to potentially approach it for Newmont. But like I said, I mean, we are at a tricky level here, bouncing on the 150. And I think it's probably got another 8% or so worth of downside if it violates that. But on a valuation basis, I like it, and I still like the metal. So I hope that's helpful. Okay. Another question that we got was about C-Web and K-Web. So let's just talk a little bit about something I think this is also election related, I think, and I've mentioned this before. So what are the positives here? A lot of the Chinese stocks are trading, especially the big ones. You know, I'm thinking Baba, for example, Pinduoduo, which owns Temu, which you probably see pop-up ads for. These companies are trading at remarkably cheap multiples. They did get a big pop, and then they've sold off quite sharply very recently. And I have a chart here which I think is kind of in alignment with this. This is in Chinese yuan. Let me just convert this to dollars so that it is just more intuitive for us, because the ADRs and the ETFs and things like that are all priced, or the trust shares are all priced in dollars. So, I mean, you can see that this thing is trading in, you know, round numbers, 10 times 2025 calendar year numbers. This is an approximate thing because their fiscal year actually ends in March. But, you know, we're looking at maybe 10, 11 times, I guess, probably a slightly more reasonable multiple. So exceptionally cheap for something that's growing at 7-8% on the top line, and should be able to achieve at least as much on the bottom line. So what is going on here? And I had a chart. Let me see if I can pull it up. That I think, okay, here we go. So when it was early August or thereabouts that we really saw that trade take off. And there was the principal reason that was given for this was that there was going to be Chinese stimulus, and they need it. Let's be honest. So they've got an aging demographic, which is problematic. They have a big debt crisis there associated with overbuilding on the real estate side. Some form of stimulus was needed, and they announced that there would be significant stimulus. So that creates some measure of support for other assets there, just like it did when we did that here in the United States and in Europe. And it also stands to reason that they're halo companies, the Baidus and Babas and Pinduos of the world, that those companies are, you know, they do lend some national prestige for China. It makes sense that Xi would try to, you know, basically help support them in some way, and that his efforts to shore up his economy are likely to help out. Also, they need to diversify their economy somewhat and away from things like real estate. And so presumably that would be helpful for publicly traded equities. So what has happened since? Well, one of the things that happened was that if you're taking a look at the election, Trump has had quite a lot of negative things to say about China, and has indicated that, you know, he wants to impose much stricter tariffs and that sort of thing. And it seems to me that that trade has weakened considerably as he has crept closer to Harris's numbers recently. And we can sort of see that here. I should probably shorten this up a little bit so we can get a closer look. So instead of looking at 1 year. So here we are. So you can see that basically we had a situation where Trump was winning against Biden, I think. It would be reasonable to say. That's what the polls were certainly suggesting. Biden stepped back. Kamala stepped in, and she started polling very favorably relative to Trump, at least initially. There seemed to be some enthusiasm straight out of the gates for her candidacy. And as that happened, you combine that with all of the economic relief that the Chinese government was, presumably going to lend, and you got this huge surge. And that would only, of course, been fueled even more so by the fact that these companies are exceptionally cheap. Since that time, some of the bloom is off the rose, I guess we could say. The polls are suggesting that they're polling much closer. So take a look here. So here's early August, and you can see that things were very tight. I'm trying to remember exactly when she took over. Widened, what was the peak of her lead in this? 3.5% I just saw. But I think over the course of the last week or so that gap has narrowed significantly. And I think that is not going to be a positive for Chinese stocks. So what to do? First of all, I still believe that the companies are cheap, if their numbers are to be believed, which is a separate issue. And I also think that they are going to have meaningful economic stimulus. I'm not that great at betting on the outcome of elections. I bet money with several people in 2016, and I was wrong. So you can guess who I bet on financially there. So I would just offer that. And of course, we have a lot of ballots in the mail. I don't know exactly what the implications of all these things are going to be, but suffice it to say that if Kamala wins, my guess is that that's going to reduce concerns about tariffs on China somewhat. Not entirely, because I think that some of that's not bad policy. We shouldn't be giving some form of unfair advantage to our competitors and just importing these goods. And I think there's security reasons for this as well. And that might even be encouraged more by the most recent Huawei Taiwan semi controversy. So not precisely related to things like Baba and Pinduo. But the fact is that we recognize we have we don't want to be overly dependent on China as a country. Not for our most basic goods, and certainly not for circumstances where they may have access to proprietary technology. So I think that the trend is not necessarily in China's favor in the general sense when it comes to trade with the United States here and now. But I do think that Kamala is probably less of a threat to them than Trump. So my expectation would be that these ETFs and these stocks would probably do better relative to U.S. stocks if Kamala wins than if Trump wins. I don't know that that's highly controversial. I'm happy to get your input on this, and I'm looking forward to it. I'm glad I got some of your questions ahead of time, too, by the way, because my social media system thing is not pulling up, so I'm not actually able to see your questions. But luckily you guys had a number of other ones, so hopefully we can move on to those. Okay, so now Amazon. And by the way, if anybody put any questions into the chat. Oh, okay, yes. I am seeing them. Okay, Eileen says, really love your show and the way you share your process. Out of interest, have you ever used algorithms? I don't know how to code, but can see how they might be helpful. Well, yes, certainly have used algorithms of different types. And so the context for the use of algorithms depended on what type of trading we were talking about. So as just a reminder to those of you who don't know, my background was stat vol arb, principally on the options side in the early days, which meant that I was looking for opportunities to trade the price of options within a given underlying against one another, or within a number of constituent stocks against indexes that they may have been a part of. And of course, that's highly algorithmic. It's models and algorithms both. So the models are really about trying to establish whether one option is cheap or expensive relative to another, or just in general. In other words, if I can buy an option for 30 vol and I think the stock's going to realize 40, that's something that we might want to do. If I think that the correlation of stocks is going to be higher, then maybe I want to be long index and short single stock vol. And if I think that correlation is going to be lower, the opposite, which was actually the traditional trade in the late 90s for people to be in. So we certainly used models and algorithms for that. We use algorithms for something else, which is that when we traded really large blocks of options, and the largest trade in terms of contract quantity I ever did was about 250,000 contracts. We did that over two trading days. And when you trade a really big block of options, it's not that easy to just click it, just say, oh, well, we're going to buy these or sell those. So you need to be able to push quotes. So we had to push quotes. We had to do what was called iceberging, which means you're leaving a portion of your order out there. The street doesn't really know how much you're really trying to do. Although, of course, they figured out pretty quickly. If you trade 100,000 contracts and they see a bid, they can suspect that there's a lot more there. So there will be circumstances like that. Or when we were trying to cross volume, sometimes we would use algorithms for that kind of thing. So, for your purposes, though, I'm not sure how important algorithms are, but I would, if you can get some basic building blocks, there are screening tools and things like that. You can see, for example, the things that I tend to care about. Obviously, I have some interest in the technicals. I have significant interest in the fundamentals. The real interest in fundamentals is because prices are going to fluctuate, and I don't know exactly what the right price for a stock is. So I'm just hoping that if I buy one, I'm buying it at a number that I think is significantly cheap, or at least significantly cheap relative to other stocks. Let's actually just work. You know what? I was just talking about with a former colleague. Let's just talk about a very specific example. We'll look at two transportation stocks. So we'll look at, or three, actually. I'm going to use four, because I was talking about four different stocks. Okay, what are those stocks? United Airlines, Delta Airlines, we're going to look at this one. CSX, the rail company, and Old Dominion, which is a trucking company. So OFDL, ODF, OGF, there we are. Okay, so these were just some companies I was looking at earlier today. Now, why was I looking at them? So first of all, bullish on United. I've mentioned this, I think, in a couple of tweets, and I think I brought it up on one of the CNBC shows about a month ago or so. I brought it up before. I may have even brought it up on the live stream, come to think of it, on or around United earnings. Now, United has absolutely taken off. It has outperformed. It's outperformed Delta by a huge amount. So why did I bring up Delta? Well, one of the reasons is that I actually I sent a joke tweet about this. For some reason, my colleagues on CNBC, just like they always have to say JP Morgan is the best money center bank, they always have to say Delta Airlines is the best airline. And maybe in some way that's true, but ultimately we always have to start caring a little bit about price, and we have to care about operating results and compare these things. So let's just take a look at those two. But I'm just going to pull up a chart of UAL first, because I want to make the point that this was something that I, looked at before earnings. And let's see, so it's back around here somewhere. It's probably late September. Stock's obviously up huge since then. It's up like 33%, I think, since I mentioned it, and way, way more since early August. But here's the thing. Take a look at some of their financials. Top line, good, respectable year-on-year growth, right? So trailing 12-month growth, 6.7%. Full year forecast growth of about 5.5%. Next year expected to grow the top line by about 7%. Take a look at the earnings. So we're getting good, this year, close to 10% year-on-year adjusted EPS growth. Some expecting as much as 20% year-on-year EPS growth for next year. And then take a look at the multiple. So the stock's trading $80. And right now the consensus view for next year's earnings is about $12 in adjusted EPS. So even now, this thing is trading in the single digits relative to earnings. But there's something else I want you to look at on this really quickly before I switch over to Delta. And that is, so it's a $43 billion enterprise value. So enterprise value, for those that don't know, is just the combination of the value of the equity and the debt. So we're not taking a look at the value of cash on the balance sheet. But they have a lot of cash, so not net cash, because they've got $30.5 billion in net debt, a little over $14 billion in net cash. Why does that matter? Well, I mean, all else equal, you like to have, if you had two companies that both had $16 billion in net debt and annual revenues of, call it $60 billion, it's good to have more cash than less, all else equal, right? So if you compare that to Delta, Delta's got about $4 billion. And so they've got $20 billion of net debt. And these are comparably sized businesses. It, too, is trading at a single-digit multiple, but it hasn't had quite the same top-line growth. And so, I was looking at that, and it has an enterprise value of, $58 billion. So United enterprise value is 42.8. And that's on $2 billion of free, let's call it $40 billion, just to make the math easy. So $40 billion, and we'll call it $2 billion of free cash flow full year 2025. So that's 20 times free cash flow. So 5% free cash flow yield over the enterprise value, if you think about it like that. And, you get a similar kind of a number for Delta. So you say, okay, so far so good. What's the big whoop? What's the difference? Well, one of the differences, I would argue, is that United Airlines, at least on the top line, they seem to be getting a little more growth out of the equation. There's something else, which is that those numbers that we're looking at are forecasting a 7.5% margin for Delta. Now, Delta has some flexibility. Among other things, they own a refinery, so they have a little bit less exposure on the fuel side, and that's not a small thing for an airline. Like your three big costs, really, right? So you've got labor, fuel, and planes. That's really what it comes down to. But I guess my point is that some operating efficiency improvements to the tune of 100 basis points at United would, make this look even better. So if they could somehow narrow that 100 basis point net income margin operating gap with Delta. So just another one of these would you rather comps analysis types of things. That was a name that I was looking at. Now, also in the industrials and the transportation space, you have things like Old Dominion, which is a trucking company. And what do we got here? I mean, we have no growth on the top line, right? Not a huge amount of cash sitting around on the balance sheet. The thing is trading not 20 times 2025 free cash flow. It's trading at 45 times. So, I just thought that was kind of an interesting thing to look at. And then I was just said, okay, well, let's just pick something else in the transportation space. and it happens to be kind of going right down the middle. So it's not trading at quite the super high multiple that Old Dominion trucking is, and it's not trading as cheap as the airlines, and that was CSX, which is one of the rails. But I bring this up because, you know, you can create or build screening tools that will allow you to look at these things, and that's probably just a way to look at it, right? So United, I mean, it's tough for me to get you guys chasing it here because, I mean, it's had such a run. Things up 100% off of those August lows. It's outperformed Delta since then by about 50% or more. And yet, believe it or not, the thing is still reasonable. So it just shows that sometimes if you buy something cheap enough, you know, you get a lot of potential upside, relatively low risk. Okay. Steve Garcia, hello from Marin. There are several indices, example SPX, that we can trade cash settled options. Yeah, SPX, NDX, the Russell. Why is that ability not available on the BTC index? Okay, so, well, first of all, I would say not yet. So there's a lot more is going to come out on the Bitcoin complex in the near future, I would expect. Both presidential candidates, for example, have stated that they are, that they support crypto generally, Bitcoin specifically in some instances. So I expect that there's going to be more here. So the short version is stay tuned. You'll get a chance on that. Baba seems to be range bound. Thoughts on 100, 108 call vertical quarterly earnings release on November 21st pre-market. Yeah. So, well, this kind of goes along with what I was just saying, right? I have a feeling that, you know, the election results, if Kamala wins, probably a little bit better on a relative basis to U.S. equities. So I'm really, because I actually think that if Trump wins, it's probably better for equities generally than if Kamala wins. That's my guess. First of all, that's what happened the last time. Secondly, the things that he's proposing, less regulation, lower taxes, you know, improvements in efficiency, this and that, that would generally be thought to be probably more favorable. I don't know whether the FTC and Lena Khan and so on, if she stayed on, if Kamala wins, you know, whether that creates some overhang. But on a relative basis, I would expect Chinese stocks to outperform relative to U.S. stocks more if Kamala wins than Trump. So you have to kind of wait for that a little bit. But I do think that this stock is, of course, quite cheap. And sorry, this one is, again, going to Chinese yuan, which is not helpful because you're looking at these shares in dollar terms. But, 1011X next year. Pinduo, I'm trying to remember what Pinduo's numbers were. I know you're not asking about that, but I think I was talking about it, may not have shown them. So if someone doesn't have access, I'm just going to pull it up really quickly here. Pinduo was another one. But, yeah, I think that's a good way to play it. And actually, let's just quickly look at also what's the implied move. So implied move, it's low, 3.4%. I'd probably want to put that on. I mean, depending on your point of view, but might even put it on before the election. You know, you have that potential pop there, but maybe your expectation on the election is that it won't be a favorable outcome for Baba. Like I said, I haven't been that great at betting on presidential elections, so I'm not going to lead you guys down the path and suggest that I have been. That one I'm going to have to leave to you guys. How would you play an election volatility decline? Say SPY is likely to go up with implied vol going down over the next week. Well, that would definitely be something like a call spread risk reversal, wouldn't it? Right? So you're taking a bullish bet but short premium on balance. That would be certainly one way to do it. A buy right. You know, just long stocks, short calls is another way to do it. Just a reminder, though, if you don't remember, the S&P shot up like 10% in 2016 after Trump won. I don't think we would get that kind of pop this time, because I don't think that if he won, it would come as much of a surprise as his victory over Hillary Clinton did. I think that really caught a lot of people out. It caught me out, right? So that, I mean, I'm an example of one. But yeah, I don't think that you would get that huge 10% 2-week rally this time around. But to the extent that there is a discount to equities baking in a less favorable outcome for stocks, and I view generally that he's going to probably be thought of as being better for stocks, there's still going to be some pop when that uncertainty is erased and volatility will come in. Oh yeah, well, let's just take a look, by the way. I don't know why I didn't show just how much is baked into the cake here. So just a quick reminder, and that is that volatility, the price of options, the implied volatility for something like an index is typically going to be upward sloping. And we can generally see that. I don't know if you can see this here. So ignore all of this noise on the far left for a second. But if you just look from January on, you can see that in general, it's upward sloping, right? So that's what we would normally expect to see. It's kind of a normal contango volatility relationship for index. Single stock, of course, you might get something similar, but it's going to have bumps whenever you have quarterly earnings releases. So what do we have here? Well, we've got this big bump. And what's the big bump? That's the November 8th expiration. And the reason I'm telling you to ignore this other stuff is that the dailies, that gets really noisy. So looking at the implied volatility of an option that's going to expire tomorrow or this afternoon or whatever, it's probably not the most important thing. But what you can see here is that there's a pronounced bid to volatility for the election. And how much would we expect this to fall? Well, it's not going to fall. There's going to be, just like any kind of event, there's probably going to be a little bit of aftershock. So volatility is not going to be one and done where we're going to get a single price jump and then volatility is just going to go straight away. I'm hoping that it goes away quickly, because why wouldn't it go away quickly? I was watching somebody on a podcast recently, and the question was, which losing party is likely to be more disruptive? In other words, are we going to get some kind of a January 6th thing going on if Kamala wins? Are we going to get some other kind of, protests or something like that if Trump wins? I'm hoping that we don't. I'm hoping for an orderly transition, whoever wins, as I'm sure all of you are as well. But those kinds of things could potentially contribute to volatility if it isn't as seamless as we all would expect and hope it would be. So you could expect a couple more days. But the general sense of it is that if you're just thinking in the back of your mind, well, how much is the price of those options going to drop? Well, you can see that if you drew a curve down here, your expectation would be that volatility was going to be about 15-16%ish, right? And it's 22. So putting it a different way, you could say, well, in a normal circumstance, the implied volatility of that option, the premium in that option would be, call it 30% lower, right? So that creates a good sized tailwind. So if you get the direction right and you're short vol, that would be a way to do it. There is another way to do it, which I have talked about before, which is something like a strangle swap. And you don't usually get to do these kinds of things in index land. And the reason you don't get to do them is because we don't have so many catalysts. You, of course, have regular economic releases, things of that type that can present, a possibility of elevated volatility for the markets. But it's going to be less pronounced than this one is. Now, we have dailies, so you can choose anything that happens to capture it, but let's just say that you go out to the 8th, and SPY closed at 580. 580 straddle that expires at the end of next week is 7, what do we got here? 765, 785. We'll call it, we'll call it $15 and change. That sound about right? And that's on a 20, that's actually 20 vol. So if you figure that, what's the immediate vol crush going to be? That's going to come out, probably 30% of that comes out. But you also have to deal with the move. Okay, so what does that translate into if you're actually going to construct a trade? So we'll just build it here in options play. I'm not sure that if you're going to favor a direction, and it sounds like maybe you're favoring, I think you were favoring a bullish bet. Maybe something like a diagonal would be a way to play it. So you could, either buy a year-ending call or maybe go out to Jan regular way, something like that. Buy something that's just out of the money, and then sell a nearer dated bit of upside premium against it, something like that. And maybe you actually want to go even a little higher. I don't know. Get a trade that looks a little something like this. That would be a way to play it. So kind of a poor man's buy right. So if a buy right's good, this is going to be, similar to that. You get some upside, and this is not accounting for the vol crush, but you probably would go out longer than November because that's just going to, be just a strict play on that. You're not really, so, you could go out to November regular way if something like that you wanted to sell the 600s. That would be a potential way to play it. And a strangle swap would be another. If you're just saying, okay, I think it's going to go up or down, you could choose the implied move, which, as we already figured out, the mean absolute deviation is about $15, higher or lower. So that takes you to, what strikes would you be using? 560, 565-ish on the downside, 595, 600-ish on the upside, things along that line. So hope that helps. Well, I was asked about, let's see, let me just go here. I know you like GLD, Monday Morning Quarterback. Like GLD, do you like SLV also? Yeah, actually. And, it's interesting because, there's a relationship that usually exists between gold and silver. And gold really had been sort of outpacing that ratio a little bit, and more recently, let's go like this. Normalize that. So, yeah, I mean, we're looking at, and silver often had a lot more sort of bang for the buck, kind of like the miners. Could definitely be a little bit more beta, higher beta trade. Gold is at all-time highs. Silver is not. Bearing in mind that silver's all-time highs, we go back to the 70s when we had, the Hunt brothers cornering the market. That was kind of a different thing, obviously. But, yeah, I do generally like silver as well as gold. If you buy the miners, if you buy something like GDX, you're going to get exposure to both. If you buy something like a Barrick ABX, you're going to get exposure to both. Newmont's pretty much all gold in terms of revenues. I think 90% is gold, but sure, I think silver is fine. Let's just take a quick peek at the implied volatilities. I'm looking and expand this just a little bit. See what we think of the options prices. They seem reasonable, right? So this is 3-month implied volatility versus 60-day realized. And you can see that these things are very close to one another. So, yeah, no reason you couldn't use long options or spreads in that area. Okay, what do we have here? Steve Garcia, how do we submit questions when you are not live streaming? Some of the questions you are answering were posted yesterday on a day you don't do open mic. Yeah, so choose one of the old videos and just drop a comment in, and hopefully we'll see it and can pick it up that way. Sometimes if somebody asks me a question and if you reference the live stream on a Twitter tweet, X, whatever you want to call it, I have a habit of calling it Twitter still. So if you send me something there, at Michael_Co is my X handle. So at Michael, MICHAEL _KHOUW. I might see it there. But yeah, just drop a comment in one of the most recent videos, and hopefully I will see it. And it's good because that way, if I was, like today, unable to pull up the chat straight away, I was having some problems bringing that up, then I already have some things to talk about. So we have that. And did I see Steve? Hello from Marin. You're in Marin. Okay. I'm also in Marin. So we can't be that far from one another. Marin's not a huge county. Okay. Let's see. Always traded risk reversals on a 1-for-1 for even or slightly deviated ratio. Monday after Taiwan semi dropped, I sold 5 NOV 185s and bought 2 November 200 calls. I want to get long the stock. Thoughts about a ratio? This is actually, I'm glad you brought this question up because it gets to something fairly important. And I would like to illustrate it now. So let me pull up options play once again, if I can just figure out where I dropped that. Did I close that window? Oh, here we are. Okay. So when I think about risk, one of the things, if it's just a straight directional bet, you should be thinking about it in terms of notional net of premium collected or spent. So in a ratio case, let's go back to our United Airlines thing. Okay? And, the trade I'm going to show is not necessarily a trade I'm recommending, but I think it will be good for illustrating something. So the stock not that long ago was, trading down, much lower. It's obviously it's had a huge run. So let's just say, for the sake of argument, that it's this pre-earnings number. You're saying, gosh, I really wish I could have owned it at that pre-earnings number. So you want to put on a call spread risk reversal, and that's the put you're looking at. But it's down a ways. So you think to yourself, okay, well, I'm going to go out some distance in time. Let's just go out pretty far, and I'm going to get short the 65 puts. And then I'm going to buy something close to at the money in terms of a call, and then sell a higher strike call. Again, this is for illustrative purposes, but I do want to point something out here. Well, if you sell a 65 put versus selling, say, an 80 strike put, what is the risk? Well, the risk is that you're going to own the stock at $65. Well, if you were willing to own the stock at 80, if you're willing to buy 100 shares at 80, wouldn't you then be willing to buy 125 shares or so at a lower price? You're still risking the same amount of money. And not only are you risking the same amount of money, but the stock, of course, has to go to a much lower level for you to lose any of it, right? So if I bought 100 shares at 80, I'm risking $8,000. Goes down 10%, I'm down $800. If I take the risk of buying $8,000 worth of 65 and it goes down 10%, I actually haven't lost anything. 65 is much more than a 10% decline in the stock price. So in that case, yes, you can sell more downside puts. First of all, even just to get to the 80, I would need to sell Now you can't, of course, because options have 100 shares per contract. But if you were willing to do a 3-lot or a 4-lot at 80 or 82.5, wouldn't you then be willing to do a 5-lot at 65, right? So let's just take a little bit of a look and put some ratios in here so we get a better sense of what this looks like. Okay, so now sell 565 puts, risk of being long 500 shares of the stock at 65. So $32,500 worth of the stock is what you could potentially have put to you down at that level. Takes a decent decrease in the stock price. It's got to go down $15.5 for it to get there. And now you're, net collecting premium. So you could actually bump this up a little bit. And then on the short side, you can even ratio that out a little bit. So rather than saying the 90, maybe I say, okay, well, I want to actually sell the 95s, more of an upside, but I'm going to sell slightly more of them. So it tilts down like this. And then you start taking a look at these break-evens. And that upside break-even is $136. That would be quite a move. So your profits are going to drop off as the stock exceeds your short strike because you are short more of them than you are long. But that's going to, you're actually not going to have any losses to the upside until the stock's trading $135, $136 or thereabouts, which is up significantly from where it is right now. Now, would I do it this way in United Airlines specifically? Actually, the answer is no, but that is only because the company is trading at such a cheap multiple that at $135, remember the thing's trading 7-8 times now. Let's just call it 8. So it's trading 8 times forward at 80. And so what does that mean? It's trading at 135, 140. Well, it's not overwhelmingly expensive. Would I short the stock at, if it's trading 8 now at 11 times, 12 times, 13 times earnings? The answer to that is no. But I'm trying to make a different point, which is that as you stretch the strikes further out, you can ramp up the number of contracts you take because you're taking less risk. You have more of a margin of safety, not just because of price movements, but because you are buying the stock at a lower valuation, you're selling at a higher one, and that kind of thing. So I do like ratio spreads quite a lot. But we're getting kind of into the deep end of the pool, so I'm just going to leave it there. We can probably get into more. I'll look for some setups that I think are maybe a little bit better than the United example. I thought United would be good simply because we were talking about the stock before, because we had a pre-catalyst price that we could look at. So before the stock really started to outperform Delta, which was right before they announced earnings. I think United was up like 15% the day they reported a couple weeks ago. Still cheap though. Okay. So I saw at least one question in the normal comment, not the live stream. Okay, yeah. Let's see. What do you make of the Intel buyout rumors, the likelihood that that might happen, whether one can position for that using options, example, March 2025, 30 calls? Yeah, I mean, Intel really has lagged. Buyout, I don't know. I have to say, it would have to happen at a fairly chunky number, right? So shareholders are down more than 50% just since the end of last year. What number would they be willing to accept? It's a big one to swallow. And why, I guess, would be the next question. It's not, I mean, if somebody was coming knocking on my door saying, hey, we're thinking about buying Intel, unless I was an investment banker and I was going to get paid for the transaction, it's kind of hard for me to see why somebody would want to do that. To get board approval of the deal, they're probably going to have to come up with a price that's close to someplace where the stock is traded within the last 12 months. So that's gonna be a chunky one. It's gonna be pricey. But yeah, I mean, if you were trying to make that play, I guess I'd probably go with call spreads, frankly, because there's a decent amount of decay. It's a high implied volatility. And yeah, call spreads would probably be the way to do it. Maybe call spread riskies. Really tough though. I have a hard time figuring out who it really represents a good strategic fit for at the kind of numbers that you would be dealing with. Yeah, I mean, I don't know. Maybe if the company and the board see that they're going to continue to have these challenges and are willing to be aggressive with their sales, where they would sell the company, maybe. But boy, I mean, shareholders probably wouldn't be all that jazzed about going on. I mean, you can see it was just back in July, the stock was trading $34.50. We go back a year, what do we got? 1 year high of 50. Wow. Yeah, you have to pony up probably. I'm guessing that it'd be more like maybe they want to buy a piece, one of their businesses. I don't know. Yeah. Anyway, how do you manage at Google Deast? Oh, you know what? One other quick thing. I want to go back to Capri very quickly because we had talked about that risk reversal. Somebody had asked about it. Stock was a little bit soft. I was going to come back to that just in terms of what the trade is. How you put on a long call risky, long finance vertical, manage it. Google Deast 20, 160, 80, 85. Let's have a peek. So yeah, that's interesting. You know what's interesting actually to me is that so we got results out of them today. Obviously, stock caught a bid, but not that huge, right? So here we are. Results were good, and stock was up 3%. Not exactly a blockbuster number. I don't know when you put your Deast trade on. Let's just construct that first of all. So it was the Deast. You're short the 160 puts, and you're long the 180 calls, and short the 185s. So you're basically in this thing. Not a bad trade, by the way. I mean, you could just stay in it. My 2 cents. I like Alphabet here. I think it's very reasonably valued. And, you know, obviously we have got a couple concerns. So what are the concerns here? Advertising rates are an issue. Apple search deal is an issue. Antitrust concerns are an issue. So those are the things that would all of those would potentially weigh on it. But on a valuation basis, boy, this thing it looks great to me. I mean, it's kind of silly when you think about it. You've got great free cash flow, enormous free cash flow growth. The forecast is that they're going to do, call it $9.20-ish a share full year 2025 at $175. I mean, that's certainly better. Seems like a better do than the market overall, right? Trading 25, 26 times. So I think the trade is fine. I think you could probably just, look to leg out of it, just based on the stock price fluctuations. So, if you start to catch a little bit of a bid, you could cover that short put. So if you get up to around, $1.80, it's not going to take much for it to get there. Look, if it simply moves as much over the course of the next several weeks as it moved today, which certainly seems plausible and is warranted based on valuation, in my view, that trade's going to work in your favor. And right now it's zero cost, right? So you may have put it on for close to zero cost. You're still right there, but I think you're well positioned. And the other thing is that think about the downside risk you face. Stock's trading 175. You could be put the stock at 160. So whatever, 8% discount, a little bit smaller discount than that, I guess, to the current stock price. And but yeah, I like that trade. So I would stay in it, and I actually think the stock goes higher. And I think it's very reasonably valued. Okay, what else we got here? Because I was just reminded in our short-handed production booth that we have run for an hour and 10 minutes already. So I have chewed up the clock. So with all of that, I want to thank those of you who joined us live today. Thank you for doing that. For all you guys that put questions and comments in, really appreciate it. And I'm happy to respond to those. And if some things occur to you in between, just put them into the general comments on the channel associated with this video, and I'll look at it before we go into our next video, which is going to be next Monday at 4:15 Eastern Time. And that's the big one, right? Because election is the following day. So that'll be the last live stream we do before we know the actual outcome, the actual answer. Thank you all very much for watching. See you next week.